In this video, I want to hopefully answer a bunch of questions that I've received so far. Is how do we look at a particular company and how do we analyze a particular company? And in times of stress like this, it becomes very difficult to do because all companies have a heightened level of uncertainty. But I'm going to show you how to look at credit spreads. We never look at credit spreads as equity investors and equity traders. We ignore credit spreads. But I'm going to show you how the information in credit spreads from day to day and over time can tell you where the valuations or the expected valuations of equity will go. And then I'll give you a model, a way to think about organizing the stocks you have in your portfolio by the credit rating of their lowest quality debt and how you can migrate to a safer place if you're suffering major losses in some issues. So let's think about how we would incorporate the idea of credit spreads into a valuation or into thinking about valuation. We're going to use something called a build-up model in coming to a required rate of return. And what that means is that every time we invest in something, there has to be some promise of return, otherwise I'm not going to do it. And the riskier the item that I'm investing in, the riskier the asset, the higher the promise of return must be. If I'm buying very short-term government debt, well, that's risk-free. Other than some small inflation risk, really small, it's basically risk-free. I'm not going to get paid a lot if I'm not going to take on a lot of risk. There's not a lot of promise of return there. But if I buy a speculative stock, its required rate of return is going to be really high because there's a lot of risk involved. I got to be paid a lot to take on that risk. So given that, the value of any company at any point in time is the present value of all those future cash flows that the company can earn, discounted at whatever required rate of return is necessary to reflect the risk of those cash flows. So it's going to help if we put this mathematically for CFA candidates out there. You're going to recognize what I'm doing. If you're a level 2 or level 3 candidate, you're going to recognize what I'm doing. I'm taking content from two different readings. One from portfolio management, the reading on economics and investment decisions. And the model that I'm going to use is a reduced form model, which was taken from credit analysis, which is, I think, the 4th reading in level 2 fixed income series. The curriculum has lightened up on that model. 2 years ago, it was really intense. Now it's sort of lightened up. If you've been watching the YouTube channel, you'll notice that I uploaded a whole bunch of videos on credit analysis. I took that reading, that dead reading from 2 years ago that we weren't using, and I put it on YouTube. So it's in the fixed income playlist for level 2. So if you want to see a more rigorous treatment of what I'm about to do, you can watch those series of videos. So let's begin. Let's think about the value, and if you see me looking down, it's because I'm writing on my screen down here. I use a Cintiq, a 13D Cintiq, which is a flat screen that sits flat on your desk, and you write on it, which is what you're seeing. So let's think about the value of any stock we buy. We know is the present value of all future cash flows, so we know it's going to be a sum of a series of cash flows into infinity, basically. And we're going to discount some cash flows. And they're going to be expected cash flows, so we'll stick an E in front of it to denote that we're discounting future cash flows, what we expect to happen. And we'll put a little tilde above the E to denote that these are risky cash flows. They're not guaranteed cash flows like a government bond, where we know exactly when we're going to get cash flows. We don't know what these cash flows are going to be. So we put that little tilde to denote that they're risky cash flows. The riskier the cash flow, the greater the discount rate. Let's look at our denominator now. And we're going to use a build-up method to determine what we would discount these cash flows at. We know we're going to get the risk-free rate, whatever that happens to be. And we're going to get some compensation for expected inflation. To that, we're going to add a credit premium. And then to that, we add our equity premium because we're coming up with a value for equity. We're going to focus on these two terms today, particularly the credit premium, and show how the credit premium and keeping our eyes on credit premium are related to the value of our equity. So what has to happen for the value of our equity to drop in value? A couple of things. The numerator, the cash flows, can get riskier or smaller. So we can have a company whose future prospects, its growth prospects, has slowed down, so its future cash flows will be lower than what we thought they were. The market will reprice that equity lower to reflect lower future cash flows in the future. Perhaps the cash flows got riskier in the sense that maybe it was the only competitor in a certain space and it was growing at a certain rate, and a bunch of competitors moved in. Well, that puts that cash flow of the first company into question. What's it going to look like? The riskier the cash flow, the higher the discount rate. So our cash flows could get riskier, or they could drop, or the risk-free rate could change. Increasing rates, well, that's going to increase the discount rate. We've had a 100 basis point drop in rates, basically. So this actually has dropped, and inflation expectations have become somewhat muted in the short term. I don't know we can say inflation expectations are changed in the long term. That's a whole other video. However, credit premiums have exploded, which means our equity premium is going to be higher as well. Now, why am I saying that? A company's equity will always be riskier than the riskiest debt that it holds. So we can look at a company's capital structure, we can look at its debt structure. It may have senior unsecured, subordinated unsecured, and then junior. However risky that junior tranche is on its equity, whatever risk it is on the debt, however risky that debt is, the equity will always be riskier, because debt always sits in front of equity in terms of its claim on assets. So even the riskiest debt in a company's capital structure is safer than the equity. So the equity has to promise a greater return. Otherwise, why would we invest in it? We would never say, look, you can get an 11% return by investing in the junior debt of this company, but the equity is only paying 4%. There's only a 4% promise of return. Why would I ever take a riskier asset like equity and accept a lower rate than a less riskier asset like junior debt, which is still risky, by the way, but less riskier than equity? Why would I take a lower rate? So it has to be higher. Well, what has happened to credit spreads over the last while? They've exploded. If credit spread starts to narrow, what's going to happen to the valuation of our equities? They're going to start to increase because our discount rate is going to get lower. And if our discount rate gets lower, valuations increase. So let's just have a look at what's been going on. And this is over time. This could be a number of years. And I'll just sort of, I think our yield curve sort of looks like that. Yield curve meaning wherever government spot rates happen to be extremely low. And credit spreads have increased. So if we think about where credit spreads happen to be, they're going to add some premium, significant premium to where the spot rates are. The question becomes, well, what does that look like? And you'll recall from one particular reading when we looked at the term structure of credit spreads for investment grade, we said it is either flat to slightly upward sloping, and for high yield, it is significantly upward sloping. So depending on the type of equities you have, you can sort of say, well, as time goes on, those credit spreads will actually be wider. So there's what our discount rate looks like over time. Add that equity risk premium on, and there we are. So that these values are what you're going to discount these risky cash flows at over time to come up with a valuation. So if we can watch our credit spreads, if credit spreads narrow, valuations should increase. There is a saying in the market, the smart money is in the bond market. And we will see movements there first. If we start to see credit spreads contracting, we can get ready for a rise in valuations of equity. And it's not just, we'll look at the next screen when I go through a number of categories of credit ratings. Depending on the type of equity you hold, it will sit behind some credit rating. And credit spreads might be shrinking for some issues, but maybe widening for others. So when you're looking at your portfolio and you're saying, I don't get it, these 3 stocks are up, but these 2 are still selling off, shouldn't they be going up? Well, it may be those 2 stocks are sitting behind a much lower credit rating on the debt than the other 3 stocks, and those spreads are still widening while these 3 are contracting. So to get some insight into why your equity prices may be moving the way they're moving, it helps to have some insight on the credit spreads. Now, if we see credit spreads contract, we still have this issue up here. What about these cash flows? Because you could have credit spreads contracting, but cash flows contracting just as quickly. So the economy could be stabilizing, but cash flows could be contracting while credit spreads are contracting, thereby not doing anything to your stock. And you may be saying, but hang on a second, that guy said if credit spreads contract, the valuation should go up. Yeah, as long as the cash flows either remain the same or start to increase. So let's just look at what happens to cash flows. Before this event, let's say that we had a certain level, this is dollars, and let's make these quarters, right? We had some certain level of free cash flow to the firm, or free cash flow to equity is probably a better place to be. And we probably had some idea of what the growth rate on that would look like, and the slope of this line is G. It's the growth rate of our free cash flows. And we were discounting each of these expected future cash flows by the sum of whatever our discount rate is to come up with what we thought was a fair value for that particular equity. Well, we're not going to have this. I think we know that. We're going to have a drop-off in cash flows for a period of time before it starts to recover. But there are 3 questions here. In every company that you have, the answers to these 3 questions will be different, and these are the questions you have to ask yourself about your numerator. So for your denominator, just to repeat, for your denominator, keep your eye on the credit spread. And I'm going to show you how to determine where your money is in the capital structure of credit ratings. I shouldn't call it the capital structure of credit ratings, but the structure of credit ratings on the next screen. Let's look at what we got here. We know that cash flows are going to take a hit. They're going to. So the question is, well, how much of a hit? How deep does this go? Based on what we thought our growth rate was, how deep is this going to be? The second question is, over how many quarters is that going to persist before we actually get to the bottom? Are we going to see the big hit in the next quarter and then things improve, or is this a 2 or 3 quarter progression where cash flows will drop for 2 or 3 quarters? So question number 1, how deep? Question number 2, how long? Question number 3, what does this look like? What does the recovery look like? Do we get back to the growth rate that we used to have? Or is the economy permanently changed in such a way that we only get back part of the way to the growth rate we had? Or does it persist for a lot longer time and we have a slower build with a lower growth rate down here? So those 3 things will keep pressure on your numerator, because these are expected cash flows. With that much uncertainty, that means these are riskier and riskier cash flows. That means this equity premium is going to be elevated for a period of time. The sooner a company can give you clarity on its cash flows, the sooner it can start giving you some prediction of where its cash flows are going to go and how they're going to recover, the sooner it starts to lower the risk of those particular cash flows, if the information is good. I mean, if their projections are saying this is going to be bad for a long period of time, then your numerator just got riskier. So these are the 3 big questions here. How deep? How long? And what does the recovery in those cash flows look like? That will help you determine what your numerator is going to look like and how your numerator is going to evolve over time. And what we want to see on a numerator is a rising numerator that becomes less and less risky. What we want to see in our denominator is we want to see a contraction of credit spreads, and we want to see our equity risk premium drop as well. And that happens naturally with an improving economy, with improving conditions as well. So that sort of sets up the way we'd like to think about the value of our equity in terms of credit spreads, and which is something you probably haven't considered before, is to look at your equities as bonds but the lowest ranking bond possible. So you want to look at the lowest credit rating in the capital structure that your company has, and you want to watch those credit spreads, because if those credit spreads start shrinking, the value of your equity should start to rise. If those credit spreads keep widening, the value of your equity will drop. Let's have a look at what the structure of credit ratings look like now. All right, I'm going to give you a sort of a unique way to look at your portfolio of equities. So what I want you to do when you have time, and you should always have time if you have money at risk, this is a business like any other business, is I want you to look up for each company that you have, go to its filings, and look at the notes of the financial statements, and look at its debt, and look at what its lowest ranked debt is and what the rating on that debt is. And then I want you to make a spreadsheet, and you don't have to have all of these columns. You can have 1, 2, 3, 4, 5, 6, 7 rows, and you have one column. Actually, 2 columns. Let's put dollars and percent. And I want you to look up stock number 1. Okay, it has, let's say BB plus is its lowest rating. Fine. How much money do you have in that stock that's sitting behind BB plus? And I want you to enter, this is a non-investment grade, enter a dollar value here. And do that for all your stocks. Enter your dollar values for where your equities are sitting behind, the lowest ranked debt. Because again, your equity cannot be less riskier than the riskiest debt, because debt has a claim on assets before any equity does. So it has to be safer regardless of how risky it is. So there's your portfolio, and you should have your total portfolio here, and then determine what percentage of your portfolio is sitting behind which type of debt. And if you have a lot of money sitting down here, not good. Your goal over the next little while is to try to migrate as much of your dollars to sit behind higher rated debt. So if you have money sitting down here, that's not good at all. You want to take every opportunity you can to migrate that higher in terms of the types of equity holdings you're going to have. Now, there are 2 ways that you can do that. Number 1 is take the hit. If you have a significant amount of money sitting behind C-rated debt, that's not good. That is extremely risky, and if the economy starts to improve, it's very likely that you could get credit spreads contracting on your investment grade. You can get credit spreads stable on your non-investment grade, but credit spreads still widening on your speculative and extremely speculative equity holdings. So while the market may be improving, while everything's improving, you're looking at your portfolio saying, these 6 are, why are they still selling off? Well, chances are they're sitting behind some very speculative debt. And it's the debt at that point that is controlling the value of that equity, not the economy. So you want to watch those credit spreads. You have money sitting behind very speculative debt. If it's very speculative debt, if that debt doesn't look like it's going to be paid, you're not going to be paid, period. So that means that your chance is only as good or slightly less better than the worst possible debt that they have. The way that I would do something like this is, let me just give you a little bit of room on the screen here so I could draw something out for you. If we think about equity markets, they never just do this. So they go down, but they do this. They do this kind of thing, right? So I would take these opportunities, these rallies, to move the value of equity down here into cash. Then I would take these sell-offs to migrate this to sit behind some higher rated debt. So you may have some stocks out there and you may say, well, these are good. The lowest debt rating here is still investment grade, but these are speculative. On the next rally, I'm going to lighten up down here and I'm going to migrate to cash. And the next leg down, I'm going to then take that opportunity to move into equities that are sitting behind higher rated debt. So you can start to migrate these dollars up this ratings structure so that the debt in front of you is friendlier and friendlier. And if there's a higher probability of your debt being paid or a much lower probability of your debt defaulting in that particular company, there is a higher probability of the equity being paid and the equity not being wiped out. Now, for some of you who don't like taking losses, if you're sitting behind here, you're hoping against hope, because this is usually, if the economy continues the way it is for a period of time, the risk of that default becomes higher and higher, and especially if it's junior unsecured, that debt's usually wiped out, and if it's wiped out, equity's wiped out. There is no saving. There is no saving the equity if debt is wiped out, period. And a general rule: you don't have to make money the same way you lose money. Okay, so you lost money down here. Let's move up in the capital, in the credit structure, and make money up there. So you want to migrate to companies that have higher credit quality debt. Isn't that interesting? As equity investors, we tend to ignore the debt markets altogether, but by keeping our eye on credit spreads, and every equity that you hold has a credit spread because companies have credit spreads. They're not government issuers with no credit spreads. They're going to have credit spreads. So by keeping our eye on credit spreads, we know what we're looking for. And by grouping them into, 7 broad categories here, you have your double A's, A's, your triple B's, double B's, single B, and C's. By grouping them into that, you just have to stick your company into one of those broad 7 categories and determine how much money do I have exposed, or how much money is sitting behind this credit rating. How much money is sitting behind this credit rating, and let me see if I can't move some of this up. In times like this, bond traders do that. They'll start to migrate from the lowest quality debt to the highest quality debt. Equity traders should do the same thing. They should migrate their equity from behind the lowest quality debt and start moving up and stick their equity dollars behind higher rated debt on the way up. If you want to see a more rigorous treatment of this, and by rigorous I don't mean in the sense that you wouldn't understand what's going on, but a more textbook application that goes through the model in a little bit more academic detail, in the playlists on my channel for fixed income level 2, I've added the reading 38 from 2018. It's a dead reading in CFAI content. We don't really dive into the detail of those 2 models, but it'll talk about the structural model and the reduced form model. What I've given you is an example of a reduced form model, but a structural model is there, and that's basically saying, look, let's look at equity like it's just a call option on the company's assets. And it gives you a way to think about equity as a derivative, as nothing more than a call option on the assets. And by looking at the debt, you can then value that call option and come up with a value for equity. Some rating agencies use that. I think one of these rating agencies use the structural model to determine their rating. I just forget which one it is. Anyways, there we go. An interesting way to look at the riskiness of your equity by keeping your eye where the smart money is on the bond market and watching those credit spreads.